Hey, what's up traders? In this video, I'm going to be answering a question from Mart over on the Art of Trading Discord channel or server. He asked how to draw a Fibonacci ratio between two price points. So I have a couple of scripts here. One is the AutoFib script from the built-in TradingView indicators list. If I open up this and type in auto, we have our AutoFib retracement and AutoFib extension. I've modified the AutoFib retracement script to be a little simpler and a little easier to read, and we'll break that down later. But first I want to start off by showing how to calculate the Fibonacci ratio between two price points in a simple manual manner, just to demonstrate the math behind it. So I'll open up the source code to the script and we'll have a quick look. So it's a very simple script here. We're getting three user inputs: a starting price, an ending price, and the fib level or fib ratio, this should probably say. So this is the fib ratio that we want to draw onto our chart between these two price points. It's going to be by default the 382 retracement. So the way this works is the first thing we need to do is determine which price is higher or lower to get our price low or price high. If you're performing this analysis on price action, so let's say you got the highest high over a look back period and the lowest low over a look back period, you would just replace price low and price high with the low and the high that you want to work with. So for example, price low could be TA.lowest low over the past 20 bars, or some other condition that you use to determine where to start drawing your fibs from. For this particular script, we are keeping things really simple. We actually just have two inputs here that we can modify, and the formulas here will calculate the bullish Fibonacci and bearish Fibonacci between these two price points. I've also made them confirm parameters, so if I remove the script and add it back to my chart, we can actually just click to select the prices we want to analyze. Now, the reason we have two Fibonacci ratios here, the bull fib and bear fib, is because of this. If we want to measure the Fibonacci level or ratio between this high and this low, we need to tell it which direction to analyze it in. So if I click my fib tool and I drag it from the high down to the low, now we have a bearish Fibonacci retracement. So we're looking for price to come up and hit one of these ratios in a traditional Fibonacci strategy or advanced pattern formation analysis. We're looking for these fib levels to be tested for whatever reason, whatever particular strategy we're using. However, if I draw the tool from the low down here to the high, now we have a different direction of our ratios. So now this is the number one and this is the 0 mark, and we're calculating our fib in this direction, which turns this into basically a bullish Fibonacci. So normally you would be looking for this sort of pattern. So you draw from the low up to the high, and you'd be looking for one of these ratios to be tested in a pullback for a bullish trend continuation or an advanced pattern formation. So I've written my code to separate these two Fibonacci levels, and then we can determine which one we want to draw based on where the price is, the starting price that we click is higher or lower. So I'll show you what I mean. When I remove the script, I'll save my code and back to the chart. If I minimize the editor and zoom in a little bit here, I now need to select the start price for the manual Fibonacci. If I click at this high and then the end price, I need to select next. If I click at this low, now it's drawing this blue line at the 382, 0.382 or 38.2% Fibonacci level. If I grab my fib tool and draw from the high down to the low, you can see our 382 right there. So that's drawing a bearish Fibonacci because the starting price is higher than the ending price. If I remove this script and add it back to my chart, and then I select from this low to this high, now we are drawing the 382 retracement from this low up to this high. And yeah, we're achieving that with this code here. So I will explain the code really quickly. So the first thing we do is determine which price from our inputs is higher or lower. So our price low is set to, is the starting price lower than the ending price? If so, then the starting price is our price low. Otherwise, the ending price is our price low. And then the same for the price high, but the opposite direction. Is our starting price greater than our end price? If so, assign the starting price to our price high value. Otherwise, assign the ending price to our price high value. Then we calculate our Fibonacci ratios. The way we do that is we subtract the price high from the price low. Then we multiply that difference, that price difference, by our fib level or fib ratio, this number here, and then we add the price high back onto whatever result this formula, this mathematical code here generates. That gives us our bull Fibonacci, or the Fibonacci from the low to the high. That will give us whatever ratio we put in here. So if I change this to a 618, click OK. Now our blue line has moved down to the 618 retracement. And then for a bear fib, it's the same formula. We're just flipping the values. So we're subtracting the price low from the price high, multiplying that value by the fib level or fib ratio, and then adding the price low back on. That gives us our bullish and bearish Fibonacci ratios. And then to draw this onto the chart, I have this line of code here, and we have fib price equals, is the starting price greater than the ending price? If so, we want to draw a bearish Fibonacci. Otherwise, we want to draw a bullish Fibonacci. So this code here is what automatically determines which ratio we want to draw. If our starting price is lower than our ending price, then we want to draw a bullish Fibonacci, and we're looking for retracements back down to one of these ratios. If our starting price is greater than our ending price, then we're looking for a bearish Fibonacci, and we're looking for a retracement up to one of these levels for bearish trend continuation or advanced pattern formation, however you like to use your Fibonacci tools to trade price action. Anyway, that will do it for this particular lesson. This is just a manual Fibonacci lesson. I'll leave the source code below. This is also the approach I use for determining hammer and star candles. So for example, if I zoom in on this bar right here, this green bar, or the red bar next to it would also work. If I draw a fib tool from the low to the high, one way I use Fibonacci analysis is to check if the body of this bar opens and closes above a certain ratio. So we could use the 382, for example, 382 retracement. If the body of the bar, the open and close of the bar is above this ratio, or any ratio you put in, it could be the 333 ratio, the upper third. That's what I like to use personally. Then we have a valid hammer candle. That's one way to systematize your candlestick pattern detection so that you either have a pattern or you don't. You have rules for that pattern, mathematical rules. That's how I like to analyze shooting stars and hammer candles or pin bar candles. Then you can add extra filters onto this if you want to. You can make it so that only candles that close green or higher than they open are valid hammer candles, or you can disregard that rule altogether, and this would also be a valid hammer candle even though it's red, just because it's a bullish price action pattern. We have buyers pushing price all the way back up to the upper third of the bar, and even though it closed bearish, that's still a sign of buying pressure. You can also add filters so that the bar must be a certain minimum ATR, so you can analyze the ATR over the past 10 bars or so and make sure that this bar is at least 1 ATR in size. That way you eliminate tiny little hammers and stars like this one here. Compared to recent price action, this bar right here is pretty insignificant, but using the Fibonacci rule I just explained, it would still be a valid star candle, but by applying extra filters like an ATR filter, you could eliminate price action noise like that tiny bar there from being detected as valid. I like to use the ATR for that rather than a fixed pip amount or something like that, because that way it applies to all time frames and it takes into account recent price volatility. Anyway, that will do it for this lesson. In the next lesson, we'll break down the source code to the auto fib indicator, the built-in auto fib indicator. Full disclosure, I don't fully understand how the source code works for this, but I did tidy it up a bit and I tried to make sense of some of the code and added some comments here to explain as best I can what the code is doing. Anyway, I'll speak with you in that lesson. Take care. Thanks, Mart, for the question, and I'll speak with you guys in the next lesson.